Hey everybody, welcome back to Two Guys Talkin Houses. We got three great topics for you today. We're talking 50-year mortgage, we're talking Fannie Mae dropping the minimum credit score, and we are recording this on what could be the eve of the end of the government shutdown that seems like it's taken forever. So what's going to happen with the jobs reports? We're going to get into that. But Mark, we got to start with this 50-year mortgage because that kind of came out of nowhere, didn't it?
There's a couple challenges with this. I mean, yes, it is going to drop your payment. You got a $400,000 loan, it's going to drop at about $280 a month versus a 30-year.
Yeah.
Right out of the gate. But in the long term, you're going to pay
Well, that's what I was going to
more.
say. What is that like? So if you add up all the payments of a $300,000 house and you pay it off over 50 years, I mean, that's got to be a substantial amount of money. How much more are you paying than $300,000 by the time the final payments due?
$400,000 loan, and I think it's $911,000 is what you'll pay over 50 years,
Good
as
Lord.
opposed to four something for a 30-year, which is a huge amount. I mean, people look at the 30-year mortgage now, and they look at the paperwork when they get to closing, and they're like, oh my gosh, I'm going to pay basically double for this house.
Yeah.
Well, go ahead, get ready to pay triple then, because a 50-year mortgage, that's about where it ends up.
That is unbelievable. I mean, I saw a meme on Facebook yesterday that kind of made me chuckle, and it was like, hey, this new product, the 50-year mortgage, it's like renting, but from the bank. And I was
Right.
like, that's kind of like, man, that's sort of true, isn't it? I mean, yes,
Yeah.
you're buying, you're earning your equity, and the equity is growing over time, but at a much slower rate. Is it keeping up with how home values have increased? Or is it, with that much interest and that many payments, are you looking at potentially not even being like in the green as far as your house is concerned? Let's say you actually went all the way through the 50 years. You paid off your mortgage.
Mm-hmm.
You bought a house for $300,000. In 50 years, is it going to be worth $911,000? I mean,
I don't know.
who knows? I mean, none of us have any idea we don't even know if we're going to be around 50 years from now, but
You're the real estate expert. I'm just the mortgage guy, but
it's hard to say.
it's pretty obvious to me, at least. Now your balance is going down slower.
Yeah.
Right. And so, right now, if somebody tries to sell a house a year later, and they put the minimum down payment down, typically they don't have enough to pay the realtors to sell
Right.
their home.
They're upside down with the closing costs. They got to come to the table with a check.
And with that balance going down slower, they are not gaining equity anywhere near as fast. And that is a problem long term for sure. I mean, I think it would solve an affordability issue, but it would create some other issues.
Yeah, I mean, I see the biggest issue that it could create is exactly what you just described, which is where people are upside down in their house. Even now, people bought like in COVID at the height or post-COVID, like the height of the market, they paid more for a house than they should have. And now they're turning around and trying to sell it in what is very much a buyer's market, at least here in Texas. And they're not able to get, even if they can get the exact same price they paid for it 2 years ago with the closing costs, the realtor fees, the title company, everything like that, they're actually coming to the table with the check, which is why all of these subject to investors, sort of popped up out of nowhere. They're like, hey, we'll take over your loan. You keep the debt in your name. You run with the risk there, but we will basically buy your house without you having to write a $25,000 check. And then we'll take over as the owner and we'll put a renter in there or something like that. So I could see with these 50-year mortgages, the instances of those types of situations increasing, which may be great for the subject to guys, but it might not be such a good thing for the buyers. And in reality, I still am of the opinion that if you can't afford it on a 30-year mortgage, you probably shouldn't buy it on a 50-year mortgage just to get in that house, because you're just spreading the debt out. You're not getting rid of it. And it's actually, crippling you over time because you're paying triple for the price of a house.
But Stephen, then I would have to think ahead.
Right.
I would have to plan beyond tomorrow.
Yeah.
Why would I do that? That's un-American. I'm sorry.
Well, that is true. And we do love our debt, especially consumer debt. But, and this is, I get it. It's debt for buying a house. Is a, good debt, bad debt. You can make the argument, is your house an asset or a liability? Depends on if you ask Dave Ramsey or Robert Kiyosaki. You're going to get two different answers. But,
Right.
I think
I
most
like the reference to Rich Dad, Poor Dad
exactly,
reference.
Rich Dad, Poor Dad. And, it's a matter of, I still think that buying a house should be very much a part of the American dream. It should be something that people strive to achieve, but it shouldn't be something that cripples you. And that's my concern. I get the intent with the 50-year mortgage. And I think thinking outside the box is something that Pulte and the Trump administration, they have done a reasonable job of. They're trying to figure out solutions.
Right.
I don't know if this one is the best one for the consumer,
Yeah. And interestingly enough, right now, nationwide, there is more equity in homes than there's ever been.
Yeah.
But a lot of it is people who bought like during COVID, 2020, maybe 21, before 22 happened, rates went up and everything slowed down. Right. So, and something like 40% of homes in the U.S. are completely paid off.
That alone is why a lot of people, and this is not the subject of today's conversation, but a lot of people come to me and say, with everything that's brewing right now, we're going to have another 2008. And that's what I always go back to. I'm like, most people have equity in their homes. Actually, almost half of the people have them paid off completely. So it's kind of hard to imagine a fire sale where people are just running down to the bank and handing their keys in. But you never know. You
never know.
Do you think that the 50-year mortgage is something we'll actually see, or is this just a talking point?
It's going to be way down the road if we do. It'll take a long time to put it together to make it happen.
Yeah.
You could say, and it's interesting, again, Trump often floats ideas.
Yeah.
To kind of gauge what's the reaction. And so I think that might be one of the motivations here. I don't know. Surely, if you had a 100-year mortgage, your payment would be much cheaper, right?
Right, yeah.
But
why not bring out the 200-year mortgage?
Right? Just saying. And
your grandkids have to co-sign for it, because it's going to outlive you. But
right. And I think it's it's a good time to talk about that no credit score thing.
Yeah,
the 620. Fannie Mae had set up, and if you don't know this, on a conventional loan, we've talked about this a little before, if you have a lower credit score, your interest rate is higher.
Right.
Fairly simple.
Pretty straightforward.
I always liken it to like lending money to your friend. If like your buddy has not paid you back the last 5 times you've lent him money, you're probably not going to do it again. And if you are, you might charge him some interest, and it's probably more than the guy that pays you back 5 minutes after you give him the money.
Yeah.
Every time. So, and same basic concept here, right? And so Freddie Mac hasn't had a minimum credit score for a long time. So Fannie Mae has, and it was 620.
Yeah.
And so the big news is they dropped the minimum credit score. Okay. But first problem is finding somebody who will lend to less than a 620.
Yeah.
Because you had trouble finding that in Freddie Mac.
Right.
With Freddie Mac. So it's not like it was. Now, sometimes you could get an investor to bite off on it. Usually that investor was kind of higher priced anyway. And if you lay mortgages back next to each other, right? So say you've got a $400,000 mortgage and you've got a 610 score. You're almost always going to be better to go FHA.
Yeah.
We don't know what the mortgage insurance is looking like or will look like, but we do know loan level price adjustments, which we talked about before.
Yeah.
Loan level price adjustments, like the bottom tier is below 639. So it doesn't matter if you have a 620 or a 610 or a 600 or whatever, your rate is always going to be the same at below 620. And it is as far as the loan level price adjustments go. And the mortgage insurance will be astronomical.
I would imagine, yeah. And that starts to creep into, increasing the monthly payment, increasing the debt to income, and then a lot of those folks that have those below 620 scores, I think, are going to have a hard time. Let's just say in general terms, not always, people who have below 620 credit scores don't typically have 20% down to avoid mortgage insurance. And so that's kind of, a problem in and of itself as well.
Well, in FHA, the argument is, okay, well, what if they put 20% down? Well, let's start with not. Let's start with putting 5% down. So you put 5% down, you got an FHA loan, you got a conventional loan. It's $400,000 loan either way. Difference is about $300 a month. The FHA loan is going to be $300 less a month if you have a 610 score.
Okay, and so why is it such a big difference there?
Well, because the FHA rate is lower.
Yeah.
610, heck, you might get, just under 6%. You'd be in the fives.
Yeah.
Whereas, if you're a 610 under the current pricing structures, you're probably at seven and a
No
half. I
kidding.
mean, 7.5, it might be, it's high. And so intentionally, risk equals rate.
Yeah.
Now, the argument for the 20% down thing is, well, you don't have mortgage insurance on a conventional loan. So surely it must be cheaper than an FHA loan, because FHA, even if you do put 20% down, you still got mortgage insurance.
Yeah.
It does go away after a period of time, unlike if you just put 3.5% down or whatever. But the difference in payment is still $100 more in conventional.
Yeah.
You know,
Even without the insurance.
even with, one's got no mortgage insurance and the other one has mortgage insurance.
Yeah.
Yet the one with mortgage insurance is still cheaper every month. So there's a few limited cases where this could be helpful. If you're a first-time home buyer and and your income is below 100% of the area median income, which varies by county and state, of course, across the country, then that eliminates all the loan level price adjustments. So you get the same rate as someone who has an 800 score.
It feels to me like it's a whole bunch about nothing, because it's, as you said, Freddie Mac already had no limited, like bottom limit credit score. And so now Fannie Mae doesn't, but it's like, good luck finding somebody to take that loan on. What are the terms going to be? What's the insurance going to be? Is it still a good idea? And in many cases, sometimes it's just better to, as a buyer, spend a year improving your credit. Maybe you got to rent for one more year, and that's not what some people want to hear. But, in your experience, do you see a lot of people where it would make more sense to take 6 months or so, improve their credit score, and then go at it, assuming that, prices aren't going to go through the roof as far as houses are concerned in the next 6 months? That's the gamble you take, right?
Well, this is the age-old question, right? But it's actually becoming more relevant now. We're actually seeing an uptick in activity.
Yeah.
We're seeing more credit pulls. We're seeing more contracts. We're seeing more, buyers out on the street. There's more inventory. Things are starting to pick up again. And as that happens, sellers become less willing to deal.
Yeah.
So you might pay more for the house, or you might not get as much in seller contributions for that house. So, that's something. Now, I always kind of take the approach like, hey, sir, let me look at it both ways for you.
Yeah.
Here's what it would look like conventional. Here's what it would look like FHA. Because, people get on, the all-knowing internet.
Yeah.
And they follow whatever it says. Right? Oh, I got to have an FHA loan. Oh, I got to have a conventional. I got to do this and that. And I try to explain to them both and how they benefit or maybe don't benefit them, and let them make a decision.
Sure.
But interestingly enough, I was researching this because I'm always curious what other people have to say about it, and I was curious what was out there, and I found a YouTube video. Guys like, guess what? Fannie Mae has no credit score. You're like, more people are going to qualify for a loan. It's going to be great. No word what Freddie Mac is doing yet. I'm like, well, they did it already. Like, obviously, you're not really in touch here. So right. What's going on?
That's weird, because everything on YouTube is true. Like, everything we've ever said on this show and any video that I've ever seen. So,
everything's 100% accurate on the internet. I think it was Abe Lincoln who said that, right?
And I think it was Abe Lincoln that also was talking about this government shutdown that, could be coming to an end today. It feels like Abe was the president back when the shutdown started. It's been that long. Was it 40 something days if it ends today?
42. I think we're at 42.
Did we break a record?
We did. We did. Yeah. The last record was 35 days.
There we go.
Ironically, in a Trump administration, but last time around. But it's
going to be the biggest shutdown in history.
Right,
you're going to break all the records.
Break all the records.
He's all in for the records, good or bad. So par for the course.
So we're on the eve of the decision. They are supposed to vote. They being so it passed the Senate, and it's supposed to be voted on at 7:00 this evening.
Yep.
Congress is going to come together and they're going to vote on it, whether they're going to pass this thing or not. It does not have the things that, the Democrats in particular wanted. It doesn't have some things that the Republicans wanted, honestly. But, the Democrats chose their hill to die on to be tax credits for healthcare, which totally makes sense. But they don't actually expire till the end of December. So like there was time to figure out the vote on that particular issue.
Yeah.
And so we'll see. It definitely looks like we have a lot of Democrats crossing party lines. Interestingly enough, I was reading earlier today, most of them either are not running for re-election or were just recently elected.
Okay.
Like we had an election day not so long ago, right? Like a week ago.
Yeah.
And so now, they're like, oh, I was just newly elected. I don't have to worry about this for a couple of years.
Yeah.
I'm going to just go ahead and cross party lines and do that. And if they're not going to be reelected again, they're not running again.
Do you know how many news cycles will be between now and the next time I run?
Something else will be big and a big problem. So, but hey, let's say we do get it and they pass it, which is, a lot of markets are thinking we will. What's it going to take? How long is it going to be before we're back to normal?
Well, I mean, that's what we were talking about, right? The jobs report and like the fact that October is probably going to just be a black hole. I mean, you can't go back and get data from a sample period of time that you didn't collect the data. I mean, it just that's like saying what was the temperature of the pool yesterday and we didn't stick the thermometer in there to see. You know what I mean? It's
That's a good analogy.
There's no way of knowing,
So, and not to draw this out, but, we were talking a little bit before about how they collect the CPI data, Consumer Price Index, how the Bureau of Labor Statistics, which, by the way, also handles CPI, how they collect their data for employment reports, for jobs numbers.
Yeah.
And it's fairly antiquated. Like they're making phone calls to companies. They're making phone calls to individuals. They're sending out surveys by email or mail, like U.S. mail to people. And the surveys, it's all the information. They want to have it by the end of a month so that they can report it at the very beginning of the next month.
Right.
What do you think the chances are that all these surveys are back?
None. Yeah.
Exactly. Which, by the way, explains why we get revisions.
Right.
Right. It's not they don't necessarily know how to do their job. Now, if you miss by 170,000 jobs, okay, maybe that's a little different.
Yeah.
But that's for the jobs numbers. And then for CPI, they're taking a basket of goods, essentially. And if that basket costs $100 today and it costs, I don't know, 102 tomorrow,
right.
Well, inflation went up 2%, right?
Yeah.
It makes sense. But then they're always changing the basket, like what goes in, what doesn't. They change it every so often. And then they're actually going to the store. Like they're actually going to a store and shopping for. You imagine the time it takes for, these data collectors to do this all across the country.
That's insane, actually.
And so, the White House said today, hey, guess what? Even if it passes, we're not getting CPI tomorrow.
Yeah.
There's just no way. Because the people that collect the data literally didn't have a job during the time, the time it would have been collected. There's nothing to collect. We're going to have a black data of whole of data for October of 25. Yeah. And it is what it is. We're going to see reports come out later on for November, but, we won't see October really ever.
Yeah, it's really interesting. And, I guess the other thing as far as how it affects our worlds is the jobs report, and that being a kind of a deciding factor or part of the equation for what the Fed does. And a lot of my buyers are calling me saying, hey, are we getting one more rate cut this year? And I just give them the chart that you give me, which says that it's more likely than not, but it's not 99% anymore. Now it's like 60. It's like, where are we with like looming rate cut for December?
It's interesting because we haven't had, there's an economic calendar of data coming out and, some things are more important than others, some of them and the calendar just simply say not available due to shutdown.
Yeah.
But boy, the Fed presidents are yapping away all over the place. I mean, there's like a speech every day from at least one of them. And there is a split, I guess it's a split committee on what they think they should do. But more have said now, we don't necessarily feel like it's the right time. We're not really sure. Then have said, we definitely need to cut.
Yeah.
And so that, that indicates to me that that's a moving thing. We might be 50-50 by the time we get there.
No kidding.
And we'll see, you know, but the government reopening is a good thing for sure, you know, because we can kind of get back to life as normal. But the problem is we're still going to be relying on ADP data,
Yeah.
which is not, you know, the Bureau of Labor Statistics. It's not as extensive. It relies on maybe, I don't want to say unreliable, but just not as reliable per se sources. And it's interesting. There's other companies have come out while the shutdown's been going on, because it's been 42 days, you know, that have said, hey, here's our jobs report. Here's our CPI numbers. Here's, you know, and different organizations of businesses have popped up like, hey, we can provide this data in the absence.
Yeah.
And that's really all they got to go off of. You
Yeah.
know, like the analogy of the car, I think we talked about last time. Like, you know, you have no indicator whatsoever how fast you're going. You know, like, are you speeding? Are you not? Do you let off the gas? Do you speed up? I mean,
who knows?
you know, like you can roll down the window and stick your head out and see how fast you're going.
Yeah.
You know, dog style. Because that's, you know, and that's essentially what we're doing right now is all this data. It's been a black hole. They don't really know what's going on.
Yeah.
But they have some indications.
Interesting. Well, you know, I'm still hopeful that we get one more rate cut this year. I think that Trump is going to push really hard for it, as he has been, as we talked about on the last episode. Bill Pulte said we need to have one more this year, but it needs to be 300 basis points.
3% or something like that. I'm like, I don't know if that was a great idea.
That's not going to happen.
Yeah.
I mean, any chance that it's a half a point, or you think for sure it's a quarter point if it happens?
If we get it, it's a quarter.
Yeah.
There's no question. There's not a half anywhere near in our future.
Yeah.
You know, but there's so much going on, and we have to get past this shutdown. We have to get things back to quote unquote normal.
Yeah.
You know, and it'll be a few weeks before you have any sort of data.
Yeah.
To go off of that we had before, you know, if not a whole month. We'll see.
I think that's a perfect place to leave it. You know, by the time that you guys watch this video, we will know what happened with the shutdown. So, you know, basically use that as you will. And hopefully we were right in predicting that it came to an end, and we will see next week. We will follow up.
That's right.